Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so here's some sector spidering. State Street Global Advisors is a large ETF outfit, and they're the originators of the sector spider ETFs, SSGA, State Street Global Advisors. They basically broke down the market, the stock market, into 9 sectors. And here's consumer discretionary, the symbol XLY, average trading range, average daily volume, and then what percent they are of the S&P. So consumer discretionary makes up about 10.6% of the S&P 500. So some stocks in consumer discretionary would be stocks that are like selling, consumer discretionary is things that we want but we don't need, right? So it's like plasma TVs, an Acura SUV or a BMW. Those are things that are going to be consumer discretionary. Jewelry, Rolex watches, things we want but we don't need. Okay. Consumer staples, XLP, that will be a defensive sector. That's things like Procter & Gamble, Kraft, RGR Nabisco. Those are things that we need to live on. So no matter how bad the recession gets or the economy gets, people still need to buy deodorant, toothpaste, and diapers and so forth. So those are consumer staples. And again, you can learn a lot about sector rotation and what's going on with the different sectors, and it can give you a good clue or a tell on how strong or weak the overall market is. Energy, XLE, made up of ExxonMobil, ConocoPhillips, Royal Dutch Shell, Chevron Texaco, nice ATR at $1.21 per day, and that's about 12 2/3% of the S&P 500. The XLF is the financials. This is going to be made up of your banks, broker-dealers, and insurance companies. Okay, banks, broker-dealers, and insurance companies. And the financials are an alpha sector. Okay, it's very difficult to have a good, solid, healthy bull market without the participation from the financials. Okay, and if you take a look at a chart, the financials peaked this year in February. On the Friday before President's Day, the XLF hit 1720 in February, on the 18th, right before President's Day weekend. And that peaked out, and we're down 35%. We're at like 1170, 12 on the XLF. It was down like 3% today, in the low 12s. So we dropped $5 or $6 from the peak. The broad market peaked in like May and then had a double top in July. Financials peaked in February, and they took out a big trend line, and they were making highs in February on low volume. So there's some big divergence there in the financials back in February, and then finally the broad market caught up to it. But energy, XLE, and financials, XLF, are 2 alpha sectors that should do very, very well in a bull market. And then if they're not participating, they can bring down the rest of the market if they're weak. So keep an eye on those alpha sectors. Healthcare, XLV, 27-cent ATR, average daily volume, 5.8 million shares, and about 10% of the S&P 500. Healthcare is a defensive sector. Again, no matter how bad the economy gets, people are still going to be, going to the doctor, buying prescription drugs, and the healthcare insurance providers will be doing well. So, as a matter of fact, the 2 leading sectors this year, as of September 21st, today, are healthcare and utilities, XLV and XLU. So again, if it's February, March, April, and financials are starting to sell off, and you notice that you're doing your sector rotation analysis and you're looking at line charts and candlestick charts of these sectors, and you notice that finances are weak, and XLV, healthcare, and XLU, utilities are leading, that's also a big red flag. In a healthy bull market, utilities and healthcare are not going to be the leading sectors. Okay, those are defensive sectors. And another good clue on this, recent 20% drop from the highs, you could have recognized back in, April, May, and June, and July, before the August huge sell-off that we had, the big volatility in the first 2 weeks of August. If you were noticing the strength in XLV and XLV and XLU, utilities and healthcare, and consumer staples, those 3 are all defensive sectors. Okay. XLI is industrials. It's a big industrial ETF. Materials, XLB, concrete and big material stocks is going to be in the XLB sector spider. It's only 3.68% of the S&P, though, small percentage of the S&P, but plenty of volume, very liquid. It's not a good day trading sector because it only does 61 cents per day, but you can definitely swing trade it from a week to 3 weeks or so. There's technology, XLK. Look at the percentage of the S&P. The XLK is almost 22%. Okay, so the XLK is going to be technology. You're going to have Microsoft, Cisco, Apple are all going to be in that technology ETF. If you want to find out exactly which individual stocks are in your sector spider, you can go to the sectorspider.com and take a look at how many stocks from the utilities. There might be 15 stocks in the XLU, but 10 stocks in the XLE. And you want to find out which stocks are in there, you can go to sectorspider.com, and we're going to show you those websites at the end of the webinar today. So XLK is also a alpha sector. Okay, so the 4 alpha sectors you want to keep an eye on, even if you never trade them or invest in them, you got to keep an eye on them for direction of the stock market or overall weakness or strength. Is going to be XLF, this is an alpha sector, XLE, alpha sector, technology, XLK, and the last one's going to be semiconductors, SMH. We're going to talk about that when we come up to a few more ETFs in the next couple slides. But SMH is based off the Philadelphia Semiconductor Index, also a very, technology's here to stay, gang. So SMH or the Philadelphia Semiconductor Index, you want to keep an eye on that index as well for clues on overall strength and weakness in the market. Semiconductors had a good run up, just like technology, QQs the last 3 or 4 weeks. There's the other defensive sector, XLU, utilities, only 3% of the S&P 500. But again, XLU and XLV are the top 2 sectors this year. You can go to stocktrust.com or FinViz to take a look at the top 2 sectors because I believe in trust but verify. But trust me, those are the top 2 sectors this year, which is not good for a bull market. We're almost 2.5 years into the bull market, and things are looking frothy up there at, 3 weeks or 6 weeks ago in early August, and we've had a nice sell-off since then. All of those have options as well. All of those sector spiders have options. Here's the sector spider website, sectorspdr.com. Let's see if this is going to load. I guess this hyperlink's not going to load, so don't worry about it. But write down sectorspider.com, and then there's all kinds of PDFs and information about sector rotation, and you can see which sectors are the strongest, which sectors are the weakest. Okay? All right, some other popular sector ETFs. There's the semiconductors, like I said, SMH, that's an alpha sector. You have IBE is the biotech ETF. And anytime you see low volume in parentheses, it means it's not doing 1 million shares per day. So it might not be super liquid. It might be 5 or 10 cents between the spread and the bid and offer. So do your due diligence, punch it up on a chart, see what kind of volume's doing, and see how wide the spread is between the bid offer. Okay. IYR, the real estate ETF, commercial real estate, IYR. IYE is the Dow Jones U.S. Energy, similar to XLE, a little bit different, and low volume right now. OIH is a popular ETF, oil services, pipeline and drillers and oil services companies are in the OIH. XHP is going to be your spider home builders. That's going to have Hovnanian, Lennar, D.R. Horton, etc. Those are going to be home builders. XRT is going to be retail. Your Walmart, Target, Abercrombie, and Old Navy, stuff like that. XME, spider metals and mining, very popular sector, metals and mining. Here's the DB, the Deutsche Bank Commodity Index. This is going to be half weighted towards energy. So half this index is geared towards crude oil, natural gas, unleaded gas, and heating oil. Okay, Deutsche Bank Commodity Index, half weighted towards energy. DBA is the Deutsche Bank Agricultural Fund. That's going to be weighted towards agricultural, soybeans, corn, wheat, cotton, stuff like that. Okay. Here's MOO, great symbol. MOO. It's not the cattle or the milk ETF. It's going to be the market vectors, agribusiness. There's going to be your Caterpillar, your John Deere, any big company that's going to be involved in agricultural business. Maybe potash might be in there. I'm not positive, but again, you can go to these websites and find out what individual stocks are within that sector. Okay. Dow Jones IPATH commodity ETN, exchange traded note, is a commodity-based ETN that has low volume right now. ETNs are similar to ETFs, but there's a little difference. They're structured a little differently, and they're similar, but they're structured a little bit differently, ETNs, so that'll be for another webinar. Goldman Sachs is the Goldman Sachs Commodity Index, iShares. GSG is the symbol, low volume. So there's two big commodity indexes, gang. There's the CRB index, which is heavily weighted towards the CRB is heavily weighted towards grains, soybeans, corn, wheat, cotton, and oats, and so forth. And then the Goldman Sachs Commodity Index is heavily weighted towards energy, just like the DBC. So that's going to be heavily weighted towards crude oil, heating oil, natural gas, and unleaded gasoline. Okay. So there's some write down those symbols. You want to punch them into a chart and see how they're doing. If there's any reversal candles, hammer bottoms, dojis, bearish engulfing candles, supply demand trend lines. Punch in those symbols and take a look at the charts. Here's some specific commodity ETFs. Okay, I'm sure you're well aware of the GLD. That's the gold, the main gold ETF. There's also the IAU. There's also another gold ETF. There's about 4 or 5 total gold ETFs. Some of them got late to get their registration and their licensing, but there's 4 or 5 different gold ETFs. The two big ones are GLD and IAU. GDX is the gold miners index. It's an index of gold miners. That's also been doing pretty well. We may have a nice double top short term in gold. We have a tough time getting this thing above 1900 or 1950 in the cash or the commodity futures of gold. So keep an eye on that. We've had a nice sell-off gold lately. UGL and DGP are the 2-to-1 inverse. I'm sorry, the 2-to-1 same way, 2-to-1 leveraged bull symbols for gold. So if gold goes up one day like 2%, UGL and DGP will be up 4%. They're going to be up twice as much as the underlying. And in the day-to-day, those are reset. Those leverage returns are reset every day. So don't expect to get 2-to-1 leverage, past like 3 days or 5 days or 3 weeks. If you swing trade and hold a UGL or DGP, more than a day, you're not going to get 2-to-1 over a week. The way I always teach it during our classes is, let's say you're bullish on gold. September 21st, buy the UGL or the DGP. Then let's say 3 weeks, October 15th or so, gold rallies, 5% in 3 weeks. UGL and DGP are not going to be up 10%. You might be up 6.5%, 7%, maybe 8%, but you're not going to be up 10% because those leverage returns are reset every day. Okay, so then again, there's been a lot of misinformation. There's been lawsuits about that. Investors didn't realize that sometimes, and they were wondering, why isn't my leverage ETF up twice as much or 3 times as much a week later or 3 weeks later? Because they attain that leverage through derivatives, futures and options. So they reset every day. So if gold's up 2.5% in one day, UGL and DGP will be up 5%, give or take 1 or 2/10 of a percentage. Okay, but then they're reset every day, and so they're not really good swing trading vehicles. Or you could swing trade them, for a week, 3 weeks or longer. Just don't expect to get the same leverage return over time. Okay. UGL and DGP are the 2-to-1 leverage of gold. GLL is the 2-to-1 inverse of gold. And right now it's on low volume, but I guarantee if gold starts to sell off and head back to 1,600 or 1,500, the volume in GLL will pick up. So the way an inverse ETF works, or a leveraged inverse ETF, to be specific, would be if gold were to go down 2% in a day, GLL will go up twice as much, or 4%. Okay, so that's going to be going the opposite way of gold. Gold drops, $30 an ounce in one day, and that's 1.5%. GLL will be up 3%. Again, give or take 1 or 2/10 of a percent. Richard's asking, what was the symbol for the ETF for grains? DBA. DBA is the agricultural ETF, DBA, and DBC was for the energies and the commodities. Okay, so SLV, silver, is the big silver ETF. You've heard about that because we had a huge run-up in silver. We topped out at $50 an ounce in the futures, and we dropped 30%. That first week of May, silver went from 50 down to 32. We had a parabolic run-up, and then we had a parabolic drop-off as well. In a week, we dropped 30% silver back in May. If you remember correctly, I mean, I was working at the Chicago Board of Trade when I was 16 in 1980, and most of the metals were in New York. New York had the COMEX, where gold and silver were traded, and I was running orders for E.F. Hutton and at the Chicago Board of Trade, and we had a little mini gold contract. It was called a kilo gold contract. It was 1/3 the size of the big New York gold, and we had a mini silver contract. So these were like the first mini contracts. And remember, in 1980, there was a couple brothers in Texas that were trying to corner the silver market, the old Hunt brothers. So we hit $50 and change in 1980. Then we came down real hard and sold off. And then finally, 31 years later, in 2011, we hit actually the overnight high on the Globex session was like 49.85. So we came within a couple whiskers or hair follicles of $50 an ounce on silver on Sunday and Monday, May 1st and May 2nd. And then silver dropped 30%. So it was a beautiful double top. Price has memory. One of my favorite expressions when I teach is price has memory. It took 31 years between it, but we dropped hard in 1980 off $50 level, and we dropped even harder in 2011 off that $50 level. So, yeah, I think JGG is also a grain ETF, I'm pretty sure. Yeah, JGG is also a different grains ETF. I'm not covering all the symbols, but there's some other ones out there, but I'm trying to go with the ones that are liquid, that have enough volume and so forth, but I'm sure I missed a few here and there, so if you want to type them into the chat and help your other webinar attendees, that's fine, so I appreciate that. AGQ is the 2-to-1 bull silver, so again, if silver has a day where it's up 2.5%, AGQ will be up twice as much, or 5%. Give or take, 4.9, 4.95, or 5.05. Okay. ZSL is the symbol for the 2-to-1 bear silver. When silver drops, this goes up twice as fast. Okay. So when silver goes down 2% a day, this will be up 4%. Again, they're going to be reset every day, so don't expect those returns if you're going to trade them, 3 days to a week or so. Here's JJC, copper ETF, and then BAL is the cotton ETF. Both of those have low volume right now. Not enough institutional participation and not enough retail participation just yet. So, again, one thing about copper and gold, lately copper's been selling off, and a good trade on is you short copper and long gold. Copper's a big barometer or bellwether of the economy. It was above $4 a pound for many months, maybe even a year. And now we're back at 360, 350. So people have been dumping copper. It's used in plumbing. It's used in industrials. It's used in housing. And with the shrinking global economy right now, not so much demand for copper. So copper's going down and gold's going up. Another reason to keep an eye on those to give you a clue on which way the stock market's going. USO, big popular oil ETF. USO tracks crude oil. UCO is the 2 times bull of the oil. So when oil goes up 100% in a day, UCO will be up twice as much, or 3%, give or take a tenth or two of a percentage. There's also another ETN from Goldman Sachs. The symbol is OIL, or oil. That's the Goldman Sachs ETN that tracks oil as well. So you can do the USO, or you can do the OIL. Both of those track crude oil pretty well. SDO and DTO are 2 symbols that are the 2-to-1 inverse of oil. So again, oil went from 115, now we're down around 85 or so. So when oil drops and takes out some trend lines or some demand zones or support zones, the SCO and DTO will go up twice as fast. Okay, so the leverage and inverses are pretty much good day trading or short-term, 2-day to maybe 2-week type of vehicles. Just don't expect those leverage returns over time. And then the UNG is the natural gas ETF. Okay. One thing to keep in mind about the UNG, there was a big article and some information about that recently. For a while there, UNG is supposed to track the natural gas futures, and for a while there, they both were going down, down, down. A few months ago, they were in a bear trend and going down, down, down. And then the natural gas futures popped up. They hit a demand zone, and natural gas started popping up, and UNG kept going down. So it kind of got, it diverged or got, uncorrelated with the underlying. So that can happen sometimes, and some people were correct about the direction of natural gas futures. They bought UNG, and then they lost money. So that's the only one I know of that really didn't track the underlying that well because of these commodity ETFs have what's called backwardation or contango. And you may have heard that on CNBC or Bloomberg, but all that means is when the nearby is more expensive than the deferred, or the deferred contract is more expensive than the nearby. So there's contango and backwardation. So that was the reason why natural gas was going up in the futures market, but UNG kept going down. So I would probably stay away from UNG for a while until they figure that out. Okay. So that's the only commodity-based ETF that had that divergence, as far as I know. Because gold, GLD tracks gold very well, USO tracks oil real well, and so forth.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.